In this video, we'll be showing you the 10 jaw-dropping money stats of the average retiree in 2026 and why these numbers reveal a very different picture than what most people expect. Through working with clients preparing for retirement, we've discovered that the gap between what people think retirement looks like and what it actually looks like for most Americans is pretty staggering. These stats expose that gap, and that's why we're making this video today, to show you where the average retiree actually stands so you can see how your own situation compares and what it means for your planning situation. Let's get right into it. Let me start with something that might surprise you. According to the Federal Reserve, the median retirement savings balance in America is about $87,000. Half of households have less than that. Now, compare that to what Americans think that they need. Northwestern Mutual's latest research shows that people believe they need over $1 million to retire comfortably. So we kind of have a strange reality here. The midpoint in America is $87,000. The perceived requirement is over $1 million. That gap is massive, and it tells us something important. Retirement in America does not look like the marketing version of retirement. It looks far more modest. But here's where this becomes more relevant to you. You might already have $800,000, maybe $1.5 million, maybe more, right? And you might be thinking, well, this average stuff doesn't really apply to me. And that's exactly the mistake I want to prevent, because the risk here isn't only low balances. The risk is thinking that retirement is solved just because your balance is high. Let's go a bit deeper on that. For Americans aged 55 to 64, the Federal Reserve reports an average retirement balance of $537,000. Sounds more decent, right? But the median is only about $185,000. That tells us most people are nowhere near the actual average. Even the average balance doesn't tell you whether or not retirement works, and that's because retirement isn't funded by a balance, it's funded by income. The U.S. Census Bureau shows median household income for retirees sits in the mid-$50,000 range annually. So again, that's what most retirees actually live on, not account statements and not net worth, but their cash flow. And that's the pivot point that most retirement plans never fully make. The real question isn't, how much do I have? The question is, does my plan convert my assets into reliable, tax-efficient lifetime income? That is what we refer to as your portfolio income needs, or your PIN. Your PIN answers one essential question: how much reliable income does your portfolio need to generate to support your lifestyle? For a couple with $2 million, defining your PIN can clarify exactly what portion of a $120,000 annual budget, where it must come from their portfolio versus Social Security or other fixed income. This shifts the focus from, again, how much do I have, to that reality of what these assets must produce to achieve the income that you actually desire. And once you shift to that income thinking, you'll start to see everything in the next layer. Where does that income come from? The Social Security Administration reports that the average monthly retirement benefit is just over $2,000 per month. So for many retirees, that's the foundation. But Social Security data also shows that more than half of retirees rely on Social Security for the majority of their income. Now, you might not depend on it that heavily, but even if Social Security is only 20% of your income, the timing decision of when you want to claim your Social Security, it interacts with your tax bracket, your Medicare premiums, your required minimum distributions timeline, and your spouse's survivor benefit. So it's not just a monthly check, it's a structural lever. And this is where affluent retirees quietly get tripped up, not because that they don't have enough, but because their income streams aren't properly coordinated. Now, let's talk about spending. Again, the Bureau of Labor Statistics reports the average retiree household spending exceeds $60,000 per year. But for higher income households, that number often exceeds $100,000. Now, think about this. If most of your wealth sits in tax-deferred accounts like traditional 401ks or IRAs, required minimum distributions starting in your mid-70s can force large taxable withdrawals whether you need the income or not. Which means if you wait until your 70s to figure out taxes, you've already lost any flexibility you might have had. That's why this isn't about average savings. It's about sequencing, coordination, and understanding which framework you're going to be operating in into retirement. Are you in a shortfall where your income needs will exceed reliable income? Or maybe are you in a strengthened framework where your plan potentially can work, but some inefficiencies need to be figured out so you don't erode any of your returns? Or are you in sharpened where the focus is more on tax optimization, longevity strategies, and legacy planning? A lot of affluent pre-retirees fall into that strengthened framework, and that's where small structural improvements can produce outsized lifetime impact. Because here's the broader picture. Life expectancy is increasing. Healthcare costs are also rising. Tax policies remain fluid, we'll say. And Social Security is facing a long-term structural strain. The margin for error in retirement planning is shrinking, and static retirement plans built on average assumptions struggle in dynamic environments. And averages and assumptions won't protect you. So yes, the median retiree may only have $87,000 saved. And yes, many might rely heavily on Social Security. And yeah, the perception and reality are wildly disconnected. But the bigger takeaway here isn't that many Americans are underprepared, as that retirement success is not determined by whether you beat the average. It's determined by whether your income structure is resilient. So if you've built significant savings, that's a strong start. But savings without strategy isn't a plan. It's just a stack of papers that you have, right? So the next steps are to calculate your portfolio income needs, identify the framework that you're in, and prioritize your actions to help build a plan that adapts year after year. Retirement isn't a one-time calculation. It's a 365-day process. So if you're within 5 to 10 years of retirement and you'd like help seeing how all of this interacts inside your own retirement situation, not just in theory, but with your actual numbers, click on the link below and set up a quick call to help you get oriented and decide the next move for what matters most to your portfolio right now, whether that's income strategy, tax strategy, withdrawal timing, or risk control. Because retirement works best when the system works with you, not against you. Until next time, take care.